Okay, so finally, let's take a look at the news of the month, which is the crash in Kraft Heinz, ticker symbol KHC. So it's been all over the news, right? So Kraft basically announced some bad news. Number one, they are being investigated by the SEC for some accounting problems, some problems in their procurement process. Number one. Number two, they saw a drop in their operating profit margins. Number three, they cut their dividends from 65 cents to 40 cents, and that freaked people out, right? So the stock dropped from it was like $50 to about $40, $50 to $40, right? So Warren Buffett is the largest shareholder through Berkshire Hathaway, and he basically lost $4.3 billion in a day, okay? And when he was interviewed a few days later, he then said, well, I think I overpaid for the stock. Right? Well, good to have known before that. All right. Anyway, so when Facebook crashed because of the bad news, I said it was a great opportunity. When Goldman Sachs crashed because of the bad news in its 1MDB saga, I said great opportunity. When Tencent crashed, I said great opportunity. How about Kraft Heinz? Is it a good opportunity? So in this video, I'm going to bring you through my thought process, how I analyze opportunities to decide if I'll get in or I will stay out. One of the things that I do in my courses, especially my value momentum investing course, is I teach people a process which I go through, and I'll run it through with you really quickly, right? See, I believe that as an investor, the first step is you have to identify great businesses. Remember that out of the 7,000 companies in the US, thousands more in China, not all of them are great companies. You only want to buy great companies, which you know will rise in value over time. You've got a confidence that they will increase in value over time. So what makes a great business? Okay, there are a couple of things I look at, right? Number one, they must have consistently increasing sales, earnings, and cash flow from operations. Number two, they must have a positive growth catalyst to drive earnings in the future. Number three, they must have a sustainable competitive advantage that protects them from competition. We call it an economic moat that allows them to raise prices every year and prevents competitors from taking away their market share. And to me, number three is one of the most important things. It has got to have a durable competitive advantage, or I call it a consumer monopoly status with very little or insignificant competitors. Facebook has that, Google has that, Tencent has that, Microsoft has that. Does Kraft have that? We'll take a look in a short while. Next, we want a company to have high and consistent return on equity, especially tangible equity. And number five, we want the company to have conservative or low debt. You know, high debt is what will eventually cause the company to get into trouble. And so, low debt, right? So, if you can pass the first 5 steps, it's a great business. Now, you go to the shop, just because you see a great jacket, great material, great brand, doesn't mean you buy the jacket. What do? Check the price. Is it a great price? Is it expensive? If it is, walk away. Wait for the great sale. Wait for Black Friday to buy that same jacket on sale. So the next thing is to ask yourself, is the price selling at or below the intrinsic value of the company? And again, different people use different methods to calculate intrinsic value. I've got my own method. And there are times when I would agree with the way Buffett does it. There are times I would disagree. And in fact, one of the reasons, I've actually looked at Kraft Heinz before many years ago. And when Buffett bought it, I paid attention, I watched it, and I never bought it. Because at the time, I felt it was overvalued. It was too expensive, and I said, why the heck is he buying it? And sure enough, now he says, it was too expensive, right? Well, I knew that. But the question is, now after it has dropped, is it still expensive? So we're going to check it out. And finally, it can be a good business, it can be cheap, but question is this, is it on an uptrend? So again, you never want to buy a falling knife. Cheap can get cheaper, low can get lower. You only want to buy when you see a reversal in price momentum, right? So you always want to buy when it's reversing into an uptrend, it's on a dip of an uptrend, or it's at least consolidating. So I'm going to show you very quickly how I run through these 7 steps, and let's see if Kraft Heinz passes these 7 steps. All right, so the first thing I look at is, does the company have a history of consistently growing sales, net income, and cash flow from operations? All right, so let's take a look. So first thing, I'm at the income statement of Kraft Heinz. Let's take a look at revenue in the last 10 years. Now, it should be consistently growing in the last 10 years, if not the last 5 years. All right, so let's take a look. Revenue. So has revenue been growing? Yes or no? Well, let's take a look. It has actually been flat for 1, 2, 3, 5 years. It's been flat. Revenue has been flat. It grew in 2016, but it went back down in 2017 slightly. So I'll call this flat as well. So would we consider this consistent growth? Nah, it's not consistent, right? So again, if you look at something else, like you look at Facebook, you look at Tencent, it's really clear. It's consistent growth every single year. That's what we want. This doesn't meet the cut. Okay, so that's revenue. It's not bad, but it's not exciting, right? So remember, we have got so many companies to choose from. Why not buy the best? Why settle for anything less? Next, net income. Oh my God, look at that. Look at net income of the company. So you can see when it dropped for 3 years, went up for 1, dropped again for 3 years, and then it went up again. So what think is going to happen the next year? Right? Up, down, up, down. Of course, I can't predict the future. But, and I'm just joking here, but the point I'm making is that, guess what? It is not increasing consistently. It's like, it's like all over the place, right? So that's not a good business. That's not a good business, right? How about cash flow? Let's look at cash flow. Cash flow from operations, right? So again, nice increase, couldn't sustain, right? It dropped, went up nicely. Okay, so yeah, it went up here really nicely, and then we had this huge crash over there. God damn. So remember, when earnings are inconsistent, it's really hard to project where it's going to be. So I found it challenging to value this company, because it's easy to value a company when earnings and sales are consistently predictable. But when they are kind of like all over the place, it's really hard to make a projection that you're comfortable with, right? So I would say that it doesn't really pass my first step. It's not really consistent. So let's go on to the second step, future growth. I want to invest in companies that are growing at double-digit rates, at least. Well, if not, at least high single digits, right? Because again, when you're buying the company, you want to see the company growing, so your money grows. So what's the growth rate of Kraft Heinz? Well, if I go onto this website, you can see that the growth rate for the next 5 years is minus 0.41%. So this company is not expected to grow in the next 5 years. It's expected to be flat for the next 5 years. Okay, so that fails my step 2. Company's not growing. They project next year will grow at 3%, and then 5 years later it's not going to grow. So I'm not that excited about that. So it fails my step 2 again. Step 3, does it have a competitive advantage? A sustainable competitive advantage. All right. Now, so what do I mean by that, right? I like to invest in companies that are consumer monopolies, which means like Nike, Facebook, Alphabet. These are companies where they have hardly any competition, that they can raise prices, people will still come to them because of their brand. Now, Kraft Heinz, yes, they've got good brands. Kraft is a great brand. Heinz, baked beans, Kraft cheese, right? But here's a problem. The problem is that consumer tastes are shifting, right? That more and more people are now becoming more healthy. Like, for example, my wife, when we go shopping, grocery shopping, she tends to avoid processed foods. We avoid buying canned foods. We used to buy a lot when I was a kid. My dad, my mom didn't know better, but now it's like fresh, organic, right? So I always say that as an investor, it's a lot of observation and common sense. Ask yourself this question. Are you or is your family consuming more of something? Like I am a big believer in Facebook because I advertise on Facebook more and more every year, right? I create more and more YouTube videos. I generate a lot of income on Google ads. I mean, I spend a lot on Google ads, that's what I mean, right? So, and that's why I have confidence to invest in Google and Facebook, because I am a customer, right? But I find that in the last couple of years, my family and I are buying less and less canned food, less and less processed foods. We're now going for the organic stuff. We're now going for the fresh stuff. So if I'm doing that, so are millions of other families. And that's why consumer tastes are shifting and they're not getting that growth anymore, okay? And the other thing is that a lot of these processed foods are becoming commoditized. In other words, it's kind of like, it's like a commodity business. Like, so what your Kraft, so what your Heinz, you know, people are now going for new specialty brands that specialize again in organic stuff and fresh stuff. So I don't find they've got a strong enough economic moat or a sustainable enough competitive advantage. And that shows in lower profit margins, right? If you take a look at this company's profit margins, now their gross profit margins are still not bad, right? The company's profit margin, gross margin is 35%, which is still higher than the industry, which means its competitors. But if you take a look at their operating margin, it's trailing their competitors, trailing the rest of the industry. And their net profit margin for the last 5 years has sucked big time. It's negative compared to the industry that sucks, but they suck even more, right? So it's not a good industry, and it's not a good company in not a good industry, right? So that fails my next step. Boom. My next step, step 4, we want to invest in companies with high return on equity, at least more than 12 to 15% consistently, right? So what's the return on equity of this company? The ROE, or return on equity. The return on equity for the last 5 years, negative. The last 12 months, negative. It fails step 4. Step 5, does the company have conservative debt, or does it have too much debt? Okay, a quick look over here, and you can kind of like compare it to its competitors. There we go, financial strength, right? So this company has got a debt to equity ratio of 59% compared to its competitors, which are 17%. So this company has got a lot more debt than its competitors. Its total debt to equity ratio is 60%. It's more than its competitors. So this company has a lot more debt than its friends. I don't like that. I like companies with little or no debt, like Facebook, like Alphabet, like Microsoft, like Tencent, right? Low debt, little interest they pay to the bank. So it's fail step 5. Okay, so is it a good business? No, it's a lousy business in my opinion. But let's say it's a good business. Now let's assume it passed all the 5 steps. Is it a good price? Well, let's look at the charts. So let me put in Kraft Heinz, KHC, and there we go. So first of all, you can see that in terms of the technicals, the price action, oh my God, look at that. It has been on a downtrend for the last 2 years, right? On a downtrend. And when the company announced the bad news, from $45, it gapped down to $34. Look at that freaking gap. My God, shit. So it's now at $34. Okay, it's now at $34. So at $34, you know, a lot of amateurs would say, hey, Adam, this stock was at $97. Now it's at $34. It's cheap. You can't think that way. Just because it was 97 does not mean it's going back to 97. Alright, you gotta know, what is it worth now? Is it worth 34? Now I gotta admit, it was really hard to value this company because of the inconsistent profits and cash flow, right? Now, when you join my value momentum investing course, right, you'll get all the valuation tools and valuation calculators, right? At the same time, as part of my community, I would regularly post my investments that I'm making through the Telegram chat group, through my monthly updates and all those things. So if you want to be a great investor, you don't want to be alone, you want to be part of a community together with me, do join the Value Momentum Investing course at piranhaprofits.com, right? You can either join my live programs in Singapore and Malaysia. I run it live in a 4-day intensive camp. Or if you're overseas, you can join me online as well. So anyway, let me get to my intrinsic value calculator. So now, in order to calculate this, I have to change a bit of rules, right? Because if I use my normal rules, it would look worse than it is. Okay, so this is already the one where I kind of like attempted to make it better than it really was. Okay, so the first thing was to ask this question. See, usually when I value a company, I would take cash flow from operations. I'll project the cash flow, but if cash flow was not consistent, I'll project the income. So the question is, which one do I take? Because they both don't seem to be very consistent, right? You can see cash flow is like that, right? And net income, let's go back to net income, was like that. So they are both not really consistent. So anyway, I decided to take cash flow from operations because that's what I usually take anyway, right? So what do I take as the baseline cash flow to project? Do I take this one? If I do, it may not be fair because it could be an exceptional year that it was too low. Do I take this one that's exceptionally high? You know, which one do I take? Because usually it's consistent, it's not. So what I did was I decided to take the cash flow from operations, or rather I decided to take the 5-year average cash flow from operations. So I added the last 5 years, 1, 2, 3, 4, 5, and I divided it by 5 to get the 5-year average. So I call that normalized cash flow from operations. Okay, and I got the figure 2459 million. So in other words, Kraft Heinz generates an average of $2 billion, $2.4 billion in cash flow from operations for the last 5 years. So that's how I got that figure. Took the average of the last 5 years. Next, usually when I value a company, I would compare its short-term cash and investments to its short-term and long-term debt. But I found that if I use that method, which I normally use, I would get a ridiculous figure. That doesn't make sense. Why? Because Kraft has got too little cash in the bank. Look at this, guys. This is such a big company. This is the balance sheet I'm going to. This is such a big company, right? And it's only got 1.3 billion in cash. It's only got 1.3 billion in cash compared to 30 billion in debt, in long-term debt, and 1.3 billion in short-term debt. So if I compare its debt to its cash, it's going to be worth almost nothing because of the tremendous debt it had. So I had to kind of modify the way I value it. So instead of using cash and debt, what I did was I used the total liabilities of the company, which is 54 billion. And instead of using just cash, I took the total assets minus the intangible goodwill. So I'm looking at tangible assets, combining it or comparing it with liabilities, right? So the company has got 54 billion in debt, 75 billion in tangible assets. So I'm already doing the company a favor by doing that, okay? Next, what's the growth rate? So for the next 5 years, we know it's minus 0.4% growth rate. Now, how about after that, from year 6 to year 10? I've got no idea, frankly speaking. How would I know, right? But to be conservative, I'm taking the growth rate at the inflation of the US economy, which is about 2%. Now, if I want to be a bit generous, if I assume that GDP will grow at 3%, fine, I'll give it 3%. Let's put 3% growth. Okay. Next, the company has 1.6 billion in shares outstanding. And you can see that based on this figure, the intrinsic value is $23.56. Okay. Now, of course, notice if I change any of these variables, if I change this to 10%, what happens? This will increase to 24. If this becomes 20%, this becomes 26. But assuming that Kraft can only grow at GDP, okay, let's assume, okay, I tell you what, let's assume Kraft can grow at GDP plus inflation. So 3 plus 2, let's give it 5%. I'm being really generous here, 5%, and it's worth $23.85. That's it. That's the best I can do for you, my dear Kraft and Heinz. So in other words, after dropping to $34, I still think it's expensive. Okay? Based on my calculation, which I'm being very generous, I value it at $23.85. So in other words, it's a lousy business. It is bloody expensive. Still, in my opinion, again, I could be wrong. I'm not a licensed analyst. I'm not a licensed financial advisor. I'm just a damn good investor who's made a lot of money, a shitload of money over the years, and this is how I do it. Okay, and finally, my last step. Does it have upward momentum? No, it doesn't. It has tremendous downward momentum, which means there's a lot of bearishness in the stock, and it's likely from here to not go up that much, right? Probably go sideways or go down, but I don't know where it's going to go. I'm not going to touch this stock. All right, so I hope you've learned something in this lesson where we don't just look at companies to buy, we look at companies to avoid as well. So I'll see you guys in the next video. Take care, and remember to subscribe for more videos and to join my live training courses or my online courses at piranhaprofits.com. Subscribe for more videos. Join the courses. I'll see you soon. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Khoo, and I'll see you soon.